Welcome everyone. Good afternoon to all. We would like to welcome you to our third conference call with fund professionals. And it is a great honor for the RankiaPro team to continue organizing these conference calls. And we thank our three wonderful speakers for agreeing to participate in today's call. For this call, the topic to be discussed will be active versus passive investing during types of crisis. As we all know, we are in kind of a crisis right now, and to discuss which strategy is to drive performance. We're thrilled to have with us today three investment professionals who have extensive experience in the asset management industry and who will certainly provide for a very insightful conversation. And on that note, I would like to welcome Olga de Tapia, Ben Ritchie, and Spyros Agrianitis. And they are our three guests today. And I would like to take this time to present them a little bit to everyone. And these three guests are going to share their views on our conversation. Olga will represent the passive point of view. Ben will share some insight into the active investing, and Spyros, our fund selector, will shed some light on combining these two strategies when and how investors should look at this conversation and what are the possible conversations that can be started. So that being said, I would like to introduce Olga first. She is head of ETF sales at HSBC Global Asset Management, and she's based in London and has been working in the financial industry since 2000. Prior to joining HSBC, Olga worked as an ETF sales for iShares by BlackRock in London, where she was responsible for client coverage across all segments in Southern Europe in these past 9 years. So this is truly a very interesting background. And she has an MBA and a BA from Madrid and a degree in business and administration. So August, truly, I hope you're going to provide very insightful insights today. Ben is head of European equities at Aberdeen Standard Investments. Ben is the head of European equities at Aberdeen, and he originally joined the firm in 2002 on the graduate scheme. He has graduated with honors in modern history and politics from Pembroke College. That's very, very interesting background. And Ben is now celebrating the 5th anniversary of his management of the fund with outstanding results. And I would just like to say now, before we start, to congrats to Ben to this great achievement with the firm. And lastly, but definitely not least, I would like to welcome Spyros. And he's head of fund selection at Alpha Bank. Spyros has more than 20 years of investment experience and is the head of fund selection in Greece. Spyros started with Alpha Bank in 2006, and since then he has been developing the growth of third-party collaboration and assets, as well as the fund selection process of the bank. So with that being said, I would like to welcome all three of you. And if everyone is here, I would like to start with some icebreaker questions, and this is going to be our debate section. So my first question to all of you is, and feel free to answer freely, Ben or Spyros, is about the upcoming US elections. As we all know, this event can really shake up things for Europe as well in the upcoming months, and we might have a big ending before 2020 finally ends. So the question goes, how do you see the US elections impacting the European economy? And do you see any differences, maybe this impacting short-term or long-term?
Well, thank you for the question, first of all. We have seen Europe releasing its a package of, let's say, help towards the markets, and it's a green, painted green package, and it's also technology is there within the QE after COVID. So I think that Europe has a definite path which it has shown towards a greener economy, and towards technology. We might see after the elections, depending on the outcome of the elections, the US also coming in that game, which was not really keen on up to now. So we might see a stronger, let's say, a greener economy in the US also, and that coupled with Europe can bring, let's say, a global wave of green investments. So, but that all depends on the outcome of the elections. This is, I think, the biggest pillar of which we would pay attention to.
Oh, thank you so much. And I'm asking our other two presenters to maybe, this was a bit of the US side of things, but we also have some exciting things happening in Europe. And I would like to ask you guys if you see any chance for a no-deal Brexit and the potential consequences related to the asset management industry. Do you see a correlation between if, and I'm not sure how are the chances for this, but if a no-deal Brexit happens, what could be the consequences for asset management?
Do you want to start, Ben, or shall I?
Go for it, Olga, go.
Okay, I think obviously we never know, but we will have to wait and see. But it looks like it is highly likely that there will be a no-deal Brexit. That would be terrible for the UK. Terrible for the UK. Actually, in terms, I mean, my expertise is in ETFs and passive investments, and we have all prepared for this because the UK will lose the passporting rights of the stock. So this is something that we have all the ETF providers we have foreseen before, and we have all migrated to the ICDS platform, which is out of the UK. So let's say that the ETF at this moment, we are in a safe place finally, and we prepare because I mean, it's highly probably, as I said before, that there is no deal Brexit. But I don't know, Ben, if you have any other views on that.
Yeah, I'm thinking from a sort of practical perspective. I think if there is a no-deal Brexit, I don't think it makes a lot of difference in the short term because, you know, asset management companies, HSBC, ASI, Alpha Bank, I'm sure, you know, everybody's put their contingency work in place and they've got their corporations in the right place and their assets in the right place. I think it's more about the long-term impact, to be honest, and what that's going to do. Because at the end of the day, you know, the market for services in Europe is not a perfect market as it stands, right? So there's already quite a bit of friction within that. So in a situation where you're creating even more barriers between yourself and that market, is that going to be more difficult? Is it going to be, you know, easier for, you know, competitor countries to put regulation and challenges in front of you to make it more difficult to manage money out of London and hold the assets in Luxembourg, or manage money for French clients investing in Luxembourg out of London, for example? You know, will that be so easy and frictionless to be able to do going forward? So I think that's the area where there are questions and to which we don't really know the answers. And I'm sure that there'll be, you know, lots of attempts to try to, you know, take away business from London, because London's the, you know, fund management capital of Europe, and, you know, it's a wealthy and prosperous industry, and, you know, there are lots of other capitals and countries around Europe that would like to have that business. So, you know,
exactly.
I'm quite sure that there will be lots of attempts to change that, you know, almost regardless whether we have a no deal or whether we have a deal. I don't think it necessarily matters too much in terms of that effect going forward.
Perfect. Thank you very much. And really, thank you for your take on these two questions. I think it will be very interesting to see how this evolves in the coming year and what 2020 still has for us. And now, with that being said, I would like to ask Olga to start her part of the presentation and maybe shed some light on passive investing through ETFs. And Olga, please feel free to say anything about yourself, anything extra that you might want to add, and then you can please feel free to start.
Yeah, no, you presented me, introduced me very, very well. So I've been working now 2 years in asset management, HSBC, as a head of sales of ETF. I have a long experience with clients providing solutions on the ETF and the passive side. So I think this is complementing all my experience, and I'm a passionate of ETF, as you will see later in my presentation, because I think it's a great tool. It's one more. It doesn't mean that it's better than active. I never wanted to enter in that discussion because that's all days. Is another tool, I think, for clients, and is great. So yeah, that's all from my introduction. But we can go to the next slide, and then we can start with the presentation. So this, I'm pretty sure you have seen this many times already, how the ETF have grown since the most of last 20 years. And this growth continues. We see that this is continuing. Obviously, in different asset classes, we see that the growth and the speed of the growth is differentiated by asset classes, but it keep on going, and I think it is something that will keep on growing for many, many, many years. On the next slide, there's something that I wanted to touch base is because of the fixed income ETF. So first we had equity ETF, obviously, then the fixed income ETF came a little bit later, and the growth of the fixed income has been tremendous, as you can see, especially latest years, and with the projection that we expect for the next 2024, so for the next 5 years, it's still even incremental. This is because there's still so much room to grow for the ETF. So you have an idea, the market of the equity and fixed income. So fixed income, is 8 times the size of the equity. And already we have a lot of equity ETFs, but they only represent 15%. However, you look to the fixed income, there's only 3% of all the fixed income in the market are ETFs. So there's so much room to grow and catch up to the equity. So that's where I think we're expecting the biggest growth. Next slide. These are the key benefits, right? So there's many, but one of the key benefits is the liquidity that they provide. The ETFs is they trade it through the day, so you can have a price from opening the stock exchange to the closure intraday. They're very simple, so they usually track an index. The ETFs are very transparent. We can know exactly what are all the constituents of the ETF in every minute. Usually it's disclosed in all the website of the providers, but as well, we can take a look to the index. It's very transparent instrument as well. So one of the main as well benefits is the cost. Typically, the ETF has been very cost efficient, very low. TER, especially in the last, I will say 5-8 years, we're crossing a kind of a price war on providers, and really you can get access super cheap to some of the asset class, or even of those that are not very easy to access. You can get access super in a very cost efficient way. So that's one of the main as well values. Obviously very diversified, because when one click with one trade, we have access to the same exposure that we could have in a fund with 2,000, 3,000 stocks exposure. And the tax efficiency is one of the as well key benefits for some of the underlyings. For instance, depending on the domicile as well, but for instance, for UCITS ETF that are domiciled in Ireland, they have a tax advantage on the withholding tax of the US equities. For instance, if we are invested in an ETF domicile in Ireland that is UCITS, we're gonna only pay 15. The fund is only gonna pay 15% of withholding tax, whereas if you buy the stock or you invest in a fund, you're going to have to pay the 30%. So it's doubled, basically. So that's one of the benefits that have attracted massively a lot of assets into the ETF exposures into the US US equities. Next slide, please. This is how the ETFs are used. There's many uses that we have seen, and we see more and more with the time. So the main one, and they typically that we've been using for the last 20 years, is the asset allocation, right? So there's two types of use in the asset allocation of the ETFs. Portfolio managers use it either in the core allocation or tactical, so satellite. So at the beginning of the ETF, we saw more this type of use in satellite because it was new instrument, and clients, investors usually use it like a tactical allocation, trying to get exposure very quickly to any of the asset class underlying. But little by little, and because the fee compression in the industry of the ETF, the investors are starting to use massively in the core of their allocations for long-term exposures in equity and fixed income as well, so both of them. But this is, I would say, the most typical use of the ETF long-term. In terms of asset class, we use it as well to access some markets that are difficult, or typically difficult through, or by yourself buying stocks, so there's no much offer on active funds, like exposure on thematic or specific market that are difficult to access, like Brazil. Not difficult that much, but it's much faster and much easier or cheaper. Brazil, China, all these kind of typical allocations. Rebalancing is one of we've seen a lot of use as well, this because it gives a lot of flexibility into the processes. It makes it more quicker. So we see a lot of managers using it for prefer to use this ETF, but because it makes their life much easier in terms of rebalancing. In terms of the following one will be portfolio completion. This is just to fill in the gaps, right? So when you have a little bit of cash in one allocation, and then you want to keep a little bit of liquidity in your portfolio, but you want to be fully invested, you want to use an ETF for liquidity and remain fully invested. And then the rest are, I mean, I could be talking for ages, I don't want to bore you, but we use it a lot. One of the uses that I really seen a lot is in transition, in these investors that are like pension funds that are moving a lot of money from mandate to mandate. I'm talking about billions of money, and then by the time that the whole allocation is moving and migrating to the new portfolio, there is a few days, a few maybe months sometimes, and they want to keep on being allocated into the asset class, so they use ETF for a transition, let's say, time.
Mm-hmm.
And as well to adjust in terms of fixed income, to adjust the credit, to adjust the duration of the portfolio. Sometimes you increase the allocation to a fixed income ETF just to adjust it, like another tool to do that. So this is more or less all of the uses that we can have for ETF. In next slide, this is a little bit more on explanation again. So how versatile are they use it? But I think the main, this is a resume, a summary of the other slide. So just to keep in mind how easy it is to access any market through an ETF, giving you immediate diversification, how transparent it is in terms of price, in terms of constituents, and how good it is to diversify your portfolio in a very quickly and efficient way. I'm not going to stop more here, but in next slide, we talk about fixed income. I really think that ETFs have all these benefits for equity and fixed income, but I think it's more impacted into the fixed income, right? Because first, market access and diversification, right, is with a simple trade of one share, anybody can access a global fixed income, for instance, global government bond index that has thousands of bonds in it with just maybe, let's say, $20. That's giving access not only to institutional investors, but as well retail, all type of investors, and this is great. This is great. This access that is giving fixed income compared to the equity, right, is the biggest advantage that we see in fixed income. As when in terms of liquidity, in terms of spreads, because of the fixed income, ETFs is growing so much, is creating a secondary market of ETF trading. So we don't have to go anymore to the primary market to create. We can just trade on the secondary market. So it means that the spreads that we can pay for a whole index on fixed income is so reduced compared to the spread that you will have to buy if you have to buy the bond itself. So this is key as well for the fixed income. This is giving a lot of liquidity and squeeze the transaction cost for the investors. And last is the price discovery, and this has happened a few times already in the past in the market when we have let's say the markets are in stress, especially for fixed income, and we've seen that there's a scarcity of liquidity in the primary market. So we saw in 2008, we've seen this year as well after the COVID, how the primary market was a little bit dry. Let's say clients or investors that wanted to redeem, they didn't find, or if they find the liquidity in primary market, it was very expensive to redeem. However, we have seen that because of that secondary market liquidity that the fixed income ETFs are providing, we have seen that these ETF, they were giving price. Let's say there was the access to the asset class still was giving price through the ETF, and that has been super one of the best, I will say, uses of fixed income ETFs and the benefits. In next slide, we have an example actually of that price discovery, and this is a case study of the stress market in last March with the COVID crisis, and then this is showing the primary and the secondary market of the 5 largest used fixed income ETF. So you can see that the secondary market is quite high compared to the primary market. And then these ETF were giving price, keep on giving price when, for instance, you see here in May, the price was, I mean, the liquidity in primary was almost nothing. So this is a great example. I think I think it's one of the best uses of the ETF, the fixed income, and giving the price discovery. Now I'm gonna change to subject on this. I'm gonna go into the sustainable investment, which I think is been the speed of the growth of the sustainable ETF has been incredible. It has been fantastic. You've seen how in the last 2-3 years we are more than double, triple the assets, especially in 2019. And we are expecting, this is only data that I had until February this year. So it's fantastic, the growth. And I think there's a few reasons why we've seen this through the ETF. We've seen a lot of providers launching ETF in this area, in this space. And indices, obviously we're tracking indices. But I think in next slide, we can find why is this and why we see more investors using ETF to express the sustainable views. The universe is quite, it has evolved. We saw at the beginning ETF that are exclusions only. So this would be the basic of the sustainable ETF. So just applying some exclusions on depending of like we call SINs and SIN stocks, or the United Nations Global Compact principles violations. So that was the first stage that we saw, maybe 2-3 years, the first ETF. Now we're starting to see what we call ESG and impact. So these are methodologies that are a little bit more step beyond, let's say. So they apply screens or tilts based on different considerations of the ESG or climate, etc., etc. So it means that the methodology follows, we want to overweight or underweight the value depending on the scoring, all the carbon emissions, etc., etc. And then now we see lately, especially this year, a lot of ESG, well, sustainable thematic, which means that they just based in one of the considerations and not all of them together, and they tilt or they screen. And this has been very successful through the ETF because first, low fees. So the sustainable ETF, at the beginning, they were a bit more expensive than the ETF, but we've seen that now they have just reached the same level of fees than the index cap, market index cap. So very low fees. And then we see that an ETF sustainable, they give a consistency in the application of the ESG criteria, whereas in an active, maybe management, we can see different approach, different consideration, or different scorings, which makes a little bit more difficult the life of an investor or portfolio managers getting the scoring of one a portfolio. And then, to be honest, it's been quite difficult to beat on performance as well. Maybe it's just a coincidence, but for the last 3-4 years, we've seen that typically the sustainable ETF or the index, they have been underweighting the oil companies who they have been underperforming. And then we have been overweighting companies that have very good scoring, which has been actually mostly technology companies. And these companies have been having a great performance. So these two factors made that the last 2-3 years, the sustainable ETF has been outperforming to the market cap index. So it might be a coincidence, but I personally believe that trend will continue because oil companies are not going to do very well in the next coming years with all the climate change programs and regulations. And definitely, if you see, for instance, I saw recently a video, a super interesting video of how the S&P 500 was passing in the last 15 years from having most of the oil companies on the top, and the little by little it has been taken by the technology companies, right? So, and typically these companies have a very good scoring. So I think I'm going to close here. I think I love the sustainable theme, but I think I covered all the questions regarding how to use ETFs.
Perfect. Then I would like to ask Ben to continue with his part of the presentation. And Ben, if you would like to further introduce yourself or just start right in, feel free to do so. And thank you, Olga, again. Super, super insightful.
Thank you.
Yeah, great. Thanks, Olga. I guess I'm going to tackle a sort of active passive piece from the practitioner perspective, from someone who manages money. I'm not a strategist or a marketing guy, so I'm not here to kind of give you the spin on active management. I'm just going to give you my thoughts on how I think about it and how, you know, why I think there's a role for active management, but why I think it's a piece of the pie rather than the whole pie, and how you need to think about that. So if we maybe skip on to the next slide. So I guess at its very heart, and this is my own thinking, so please don't get upset with me at Aberdeen if you see this and disagree with it. Basically, the industry is being massively disrupted in a classic disruption model, right? So it's like Kodak. You come along with a product that is way simpler and much cheaper than the existing product, which is effectively over-servicing almost all of its clients for too high a fee. And you find actually over time that actually this product is actually pretty good. In fact, it serves almost everybody's needs. And as it innovates and changes and develops, it sort of takes over most of the marketplace, which, given that our industry is supposed to spend its time looking on big trends and investing money for people, it's quite impressive that large quantities of it have managed to completely miss this this dynamic over the last 10 years. So it really comes back to the end of the day is how are you going to address that challenge? You're going to address that challenge by putting together a compelling value proposition for your customer. If you put a compelling value proposition together for your customer, they're going to buy your product. And that's about returns, it's about costs, and it's about service and stewardship and what you offer around that. If you can put those things together, then you're going to have a product that people want to buy. And if you don't, then you won't. And it's really as simple as that. If we move on to the next page, I really do believe, though, quite strongly that markets are inefficient and that there are opportunities for active managers to make money within those markets. There's lots of academic debate around this, but I think you can point to studies that show that there is as much as there isn't. But I'll bring two anecdotal examples from my own personal life, which always make me smile. And these are two very simple examples. So I suspect if people can make mistakes in these two examples, they'll make mistakes when it comes to valuing multi-billion or trillion-dollar securities. So on the right-hand side is a photo of a bank that is next to my office in London. At the moment, it's probably closed. But when I went there a few weeks ago, just to see if it was still in existence, it was still there. So you can see that there's a cash point on the right-hand side of the door. It says cash above it. And it doesn't so much happen these days because, you know, these days no one really uses cash. But in the old days, everybody would queue to get their £10 or £20 out at lunchtime to go and buy their lunch. And it would be hilarious because you'd have this huge queue of people outside waiting for the cash point. Now, the mitigating factor is that actually there were 3 cash points inside the bank, which no one ever used. So if you just walked inside the bank, you didn't have to queue, you just got your money straight away. So just as a ridiculous example of how inefficient even the most basic market can be if people don't bother to do any research. The other one on the left-hand side is my personal favorite. So every Saturday, I take my kids down to the park, and there is an ice cream van. So the first 3 hours in the park are basically spent trying to stop them from having an ice cream. So that's the plan every weekend. And then we have to give in. So then you have to buy them some kind of ice cream. So in the park, there is the ice cream van, and then there is another van, or it's actually now it's like a little building. The little building looks like the kind of place that sells coffee. It's got cakes and coffee, and it makes toasted sandwiches. And then there's an ice cream van. On a hot day, the ice cream van will have a queue of 25 or 30 people queuing for the ice cream. And the coffee shop, surprisingly, will have 3 people queuing for a coffee, normally me, because I'm a caffeine addict. The ironic thing about it is that the coffee store sells exactly the same range of ice creams as the ice cream store. So if you know that, you can go to the coffee store and you can get your ice cream and only wait for about a fraction of the time which it takes to get it from the ice cream van. Now, these are ridiculous and banal examples, but it's what I think when it comes to informational efficiency in markets, even in the most basic market, people can make mistakes, don't appraise the situation. Within complex analysis of securities and markets, I still believe there is opportunity for analysis and investors to be able to exploit market mispricings and inefficiencies. Now, there's a lot less of those than there used to be 25 or 30 years ago, but within the European market, it's still a very complicated market. If you look at stocks that can be even 30, 40, $50 billion market cap securities, quite often they will only have a few external analysts. They might have lots of local analysts from the local banks that do business for them. But in terms of people really analyzing, cutting those businesses up, we find that our own internal analysis gives us far more understanding of those businesses and how they're likely to perform than almost anything you can buy on the street. So even in today's market, I believe that you can generate informational advantage. If we go to the next slide, the other piece that then comes into play is emotional psychology. So this is the other thing. And I think as models of economics have developed, the role of behavior and psychology within them have become a much more interesting and aware idea. And a lot of the axioms that underpin a lot of economic theory, people are starting to think, well, actually, that probably doesn't really have a lot of application in real life. And I really like this chart. In fact, the only way the chart could be made better is I don't have the skills to produce it myself, but as if you've got GDP, you've got corporate profits, and then you've got the stock market. And for me, those are 3 really, really interesting things, right? So corporate profits are basically going to be a function of GDP. And as you can see, GDP is metronomic. It grows steadily and consistently. Even in 2008, it's barely a blip. And even if you go, you have to see a serious dent in the chart, you have to go back to like 1929. When you overlay corporate profitability, which incorporates financial leverage, operational leverage, that line is more volatile. And then you add the stock market on top, which is a crazy view of that. So ultimately, A drives B drives C, But at any one time, investors are either overly enthusiastic or overly pessimistic, and that psychological effect can come into play. So there were two elements, I think, one about information asymmetry and one around psychology and behavioral finance. Now, I think those two things are strong elements, and they provide opportunities to be exploited. I think the key question is, can you actually exploit the opportunities, and do humans with their failings and fallibilities, are they able to actually do that? So if we maybe turn to the next slide, we can maybe sort of think about that. So one of the main reasons that I'm always told, well, you know, some funds perform, others don't. It's broadly speaking a random walk. We can't work out which ones are going to perform, therefore it's not really worth the time or effort. Okay, but I think that's a pretty pessimistic way of thinking about it. So performance itself may not persist, it may persist. But it's, I think, far from clear that professional money management is roulette. And I just wonder whether or not people are actually looking at the right things. So if I'm assessing somebody to do a job, I would think about a wide range of criteria. I might look at their experience, I might look at their psychological profile, I might look at how they've done things in the past. But there are many, many companies doing many, many different things who run very, very successful selection processes for individuals who stay within their businesses over many, many years and have a high degree of success in executing that. But they don't just look back and say, well, you know what, we might as well just pick anybody because, you know, we won't know whether they're any good for 35 years, so we'll just choose Joe Bloggs, right? There's no point having a recruitment process. Nobody would necessarily go through that. So my posit to people is actually, if we spent a little bit more time thinking about different types of data sets, analysis, and understanding, we might find actually some of the key drivers that are likely to lead us to have managers or processes which are able to consistently exploit those inefficiencies which I talked about at the beginning. And I think that's quite an important angle. So if we maybe touch to the next slide. So there's some other things to think about, I think, within the overall remit. Again, one of the arguments that's often made about, well, don't bother with active managers, is that ultimately the difference between an active manager, you know, and the benchmark really isn't that much, because the most important thing is to get the asset class allocation right. If you get the asset class allocation right, equities versus bonds versus real estate versus cash, that's the most important thing. And then as you go to, you cascade down that. So by the time you get to poor old European equities, not really much point in employing Ben, because the difference he can make overall compared to me making the decision between bonds and cash is really kind of irrelevant. Well, it's kind of true, but it's also kind of a depressing approach, right? In what other industry in the world would you not look to try and optimize your returns from the top to the bottom? And I can guarantee that most of the most successful companies in the world are looking to not only get the top end right, they're also looking to get the plumbing at the bottom end right as well. I think the concept of passive investing is also something that one really needs to think about. Are decisions really passive? Like almost all investment decisions are active to some degree. You're in the market, you're out of the market. Okay, what's the best way of exploiting the opportunities within the market? Oh, I've got a whole load of different ways of doing that. So it's never quite as simple as that. It's all about the granularity of that decision making. And I think one of the reasons why I think the active management industry perhaps gets a worse name at, say, the European equities level than it might do at the multi-asset level, is that it's very hard to say what's the real benchmark for multi-asset fund, right? It's like, who knows? It's 4%, no, it's 3, it's 5. Someone did a study once and actually it's 7.5. We just don't really know. And I think it's much easier to present that then as something which is a fountain of knowledge, as opposed to, well, you know, if you've got a benchmark, that's the number, and was your performance better or worse? It's much more transparent. And again, I think that's quite interesting, especially when you live in the world of investment consultants who are, you know, keen to sell you their latest asset allocation structure, maybe less, and it comes down to my thinking really, is it easier to pick markets than it is to pick stocks? I'm not really sure it is, or asset classes, but certain people seem to think that it might be. And there's always a decision to make, right? It's always about strategy implementation. And if you look at what Olga was saying there, you know, ultimately you've got this huge range of different assets. Now, ETFs have many attractions to them, but it's about implementing my strategy through them. And it's because I think that that particular area is going to do best, and therefore I'm going to put my money into that particular area. That's an active decision. You're just choosing a tool to be able to implement it. And I think, again, there's this thing about zero sum, the average manager underperforms. It's like, well, after cost. It's like, well, of course they do, right? That's just a statistical obvious thing to say, right? Because these days the entire market is pretty much dominated by professionals. The average manager is a professional. The return of the market is the return of the market. Therefore, the average manager is going to deliver you the market return. Hooray. So, and then it goes back to the tautology of like, well, we can't tell which ones of them are going to outperform. Therefore, there's no real point in investing in any of them. Therefore, it's broadly speaking a waste of time. And that's the kind of logic that sort of circles around. But from my own personal perspective, I'm pretty relaxed about the fact that markets may be a zero-sum game, because at the end of the day, it's about making sure that you're in the piece where you think you can deliver outperformance and where you can offer value to your clients. If you can do that, then I think there's a role for active manager going forward. And I do think that the complexity piece is actually really important. So as we go and have trillions and trillions and trillions of dollars into ETFs, and there are literally thousands or probably hundreds of thousands of ETFs out there, that very complexity then starts to make decisions more difficult, because it's not as simple as just owning the S&P 500. I'm actually going to decide which shape, shade, color of that I'm actually going to implement. And then you just go back into this whole thing again, where actually it's all about active decision making anyway. And actually the whole simplicity and ease of the whole thing in the first place is somewhat lost amidst all this information which we have. So that's quite, again, just another element to think about. So if maybe you move on to the final slide. So despite all of that, I'm actually pretty optimistic. And I'm pretty optimistic believing that actually I suspect that passive, quasi-passive money will end up probably being 80 to 90% of the market. I think in Europe today it's probably 30%, something like that, a little bit more. I wouldn't be surprised if that goes to 80 or 90% over the next decade. But actually I think that's fine, because the most important thing is making sure that you think you've got a compelling value proposition. And as the industry becomes more complex, I think the opportunity for active managers to deliver significant levels of outperformance, if they can do that consistently, with product that is able to deliver something that isn't necessarily that easy for someone else to be able to get easily, that's tailored to the client and offers high levels of service, particularly perhaps around client information provision, but also around ESG management and all the things that go with that, then actually the opportunity to be able to do that kind of thing, I think, is still there. If you go back to where the industry was 10 or say 20 years ago, you might have been charging somebody 100 or 200 basis points for a product that was maybe delivering 7%. So you were giving away 30% of the return, and the 7% was the same as the market. It's a compelling sell to then say, okay, I don't really want that. I'm going to put that into an index fund. If you're offering a product that say is delivering 300 basis points of alpha wrapped up with ESG and service, and you're maybe charging 20 basis points for that, it's a different offer completely. And so I think the game has changed, the situation is different, but I still think there's a role providing you're prepared to offer good value to the industry. And overall, I'm absolutely convinced there will be a much smaller part of the market, but it will have its place, and it'll have its place because there'll be customers out there, clients who want more than the market return. For many people, just actually investing in the stock market would be a massive improvement on their savings situation. So my parents are terrible. They always love cash. And if they don't have cash, they might put it into a house, right? That's like the British thing, right? But if they actually just put the money into equities in the most basic tracker fund, that would be an amazing starting point. So I spent many years pointlessly trying to have a younger brother who's in his early 20s, trying to tell my mum, please, please don't put the money in the bank, put the money into any kind of fund. It's got to be better. Of course, being mum, she doesn't listen to me, but making that simple basic decision is a great starting point, right? And that for most people is actually a really fantastic starting point. But there are a lot of clients out there, particularly towards the higher, more sophisticated end, who don't want 7% a year. They want 10 or 15 or whatever it might be. And more importantly than that, they don't want the 10 or 15% that Joe Wiggins is getting. They want the 10 or 15% that they can get that's different, that makes them feel like they've got something special and important, and that's quite important. So overall, when we wrap that together, despite the trends and dynamics, I remain, quite optimistic about the longer term picture. But it's going to be, active management is going to be a piece of it rather than the whole story.
Thank you, Ben. And this was again a very interesting take on thinking about active versus passive. And now I would like to give the word to Spyros. And again, as before, if you feel to say anything else about yourself or further introduce yourself, feel free to do so. And if not, you can go ahead and get started.
First of all, I would like to thank Olga and Ben. You can see our problem now. Olga addressed very important issues like how ETFs are getting into the ESG and the sustainable investment arena, and also about the bond ETFs. And Ben also addressed the one of the pillars of my presentation, which is are we talking about efficient or inefficient markets? Are there opportunities for alpha or not? So let's get on with the presentation. The first slide that we are going to see is about the bank. I'm not going to stay long here. Alpha Bank is one of the leading banks in Greece, with about 11,300 employees. Within this scheme, we reside in a department that's the investment portfolio management department, and the fund selection team is within that department. We don't try to do our own views on the markets. We are part of a larger team of analysts, and we use their analysis and the house view of the bank, and we rely on that to produce the fund selection and to let's say refresh that usually every quarter. So let's get on with that. On the next slide, we can see the confusion. These are just some news that we can see anywhere on the internet or anywhere else, and they are all addressing the active versus passive investing question. I don't think that this is a question that can be answered straight away. This is a question that has to go through the right questions. We have to find the pillars that are the ones that are going to help us decide when we go active and when we go passive. So if we go to the next slide and skip that part, we go here and we see the pillars that I try to put down and help us think as fund selectors, how we can decide to go active or passive each time. So I would say that those pillars are those that I could find are the market characteristics and technicals, which are those characteristics when we want to enter a specific market. Which is the type of service that we're talking about? Are we talking about discretionary? Are we talking about advisory? Are we talking about how do we deliver? Everything counts here, because we have to think of this whole scheme under a wealth management perspective, and not under just a narrow fund selection perspective. So how do we deliver? Do we deliver through branches and relationship managers? Do we deliver through platform? What is the house view of that you are relying on? What are the client profiles that we are talking about? And when we are talking about client profiles, I don't only mean the level of risk that they are willing to take, but it's also something that Ben, I think, mentioned earlier. Are we talking about sophisticated clients? Are we talking about clients which are happy with a final number in their portfolio? They will never look what's inside their portfolios. So, but these, let me stress that these are guidelines and not rules. There are no rules as anywhere else, I think, in wealth management. So these are guidelines, and we can go to the next slide and start with the first pillar. So what are we talking about when we're mentioning market characteristics in terms of technicals? What is the checklist there? I would say that one of the things that we have to look at is, what are we expecting from a certain market? Is it a bull market? Is it a sideways trading market? What are the correlations between within the asset classes or amongst asset classes right now? is it an efficient market or not? Are there any niche opportunities within it? Is it a deep or a shallow market? Is it a broad or narrow market? What about the standard deviation from the median of that market, whatever the median is? That is the opportunity for alpha, basically. And what are the trading costs within it? Is it a bearable market to switch in and out and trade, or is it not? So this is the technical, I would say, part. And then we can go to the next pillar of the checklist, which is the type of service and distribution channels. I think this is very important, that we have to have a holistic view when we are deciding to either go passive or active. So are we talking about advisory? Are we talking about execution only or discretionary? Is the service passive or active itself? So and if it's active, what's the level of turnover? What's the frequency in which we switch products within that service? What is the level of competition in that? Are there smarter proposals in the market? Are clients coming in and saying, I'm fine with that, or are they coming in and saying, I'm finding smarter solutions out there? How do you deliver? That's very important. Is it through financial advisors that need to have a speech when they deliver the product or the investment, or through platform? Can the client trade fast and achieve cost efficiency? Let's have on the next slide a very general, again, it's not rule, it's a guideline. I would say that active products better fit investing. And by investing, I mean medium to long-term horizons. Because then you give the fund manager or the active manager an opportunity to really show the results. Or are we talking about trading? For example, when we were at the bottom of, if we have seen the bottom, when we were at the bottom of COVID, in the middle of March, and somebody wanted to take a bet on the recovery, on a short-term bet. Do you want to risk on alpha, which can be negative, or do you want to just trade on a passive product, which you know that will be on benchmark? So investment horizon is one thing, and then on the next slide, there is a question of the service itself. What service are we talking about? Is it, and this is also a know your client thing. Active products, I think, better fit passive portfolios. Portfolios with low product turnover, portfolios which you are not trying to do everything on your own. I would say advisory is that part of the business. Passive portfolios better fit active portfolios, portfolios with high turnover. You have an investment committee there. There's a discretionary, let's say, service, and the investment committee comes up and gives a new idea every 15 days, and they want to switch or they want to do something else. Maybe benchmarking is the way to do it there, or combine. And of course, you can see that these two bubbles, these two cycles, they collide, and then you have the opportunity of doing both, of course, which could be the right way. Then we have on the next checklist. It's about knowing our clients. Are we talking about retail clients, which might not be so much sophisticated, mass affluent, or are we talking about high net worth individuals which are really sophisticated and they want to see something extra? Are clients cost conscious or cost sensitive would be the right way to put it. Is the client a trader or is the client an investor? Do you want to risk alpha with a trader, or do you just want to benchmark with an investor? So is it the client that buys a specific market, or is it a client that buys a concept, a theme, that will judge the end result out of how well did I go with the benchmark, or will he judge the end result on how well did the fund approached the theme itself? Is the client benchmark aware? So knowing your client is also a thing here when you are trying to decide, should I go passive or should I go active? How do you deliver? Is it through financial advisors? They might want to enjoy talking about the strategy of a fund instead of benchmarking, or is it through a platform? Is the client sophisticated or not? And this is not the cost-sensitive part of thinking. It's the client that really wants to read the fact sheet there and go through all the investments within the fund. And then let's go to the house view, which is the next pillar. So here, I think there are two things that we need to know. One is, what is the view that your analysts have on a specific market? Is it, are they strongly positive about something? Are they negative or mildly positive? Because these can define also if you're looking for alpha in that market or not, or if you're just going to, alpha is always welcome, but when, let's say there is a projection, let me throw some numbers. If there is a projection of a certain market, I'm going to throw out an absolute number of 3%, 300 bips on a certain market on the next 6 months. That could be a bond market, I don't know. Do you want to risk that 300 bips with, let's say, a fund manager, or do you really want to just go out and take that those 300 bips? And if it's more than that, then why not go for active management? So, and also, are we talking about trade ideas or investment ideas, long-term ideas? On the next pillar, I would go to the and mention last one, the product availability and quality. So what about the specific market that you want to enter in? So you see, it's all specific. What about the market you want to enter? Are you finding products in that market that consistently deliver alpha, and it's easier for fund managers to deliver alpha on that market, inefficient markets? Or do you have a better chance on frequently trading within the asset class, which you might need a product that is more cheap, passive, and on benchmark? So there are markets that call for active management themselves, and then there comes the issue of product support, which should be strong for a fund selector to choose an active product, because you always have to have there the opportunity to ask questions, to maybe talk with the fund manager or get frequent reports. You see how things are getting into smaller and smaller questions. Are you able to explain to your clients what went wrong? Because things will go wrong sometime in active management. So do you have the mechanism there to explain to clients why the fund underperformed. If you don't have that, go benchmarking. So all these are important concepts. Also, there comes the idea of profit margins for the businesses that still, there are businesses, yes, that still do that in small markets like Greece, where you charge on the front end. So are you willing to accept lower profit margins? Because the more you go passive, the less are the opportunities to charge upfront. I think that these are the questions that one has to answer before going deeper and deciding if you want to go active or passive. It's not just one question that needs to be answered. It's many smaller questions one has to answer and go there. I'm not going to go through the answering each one of them, but each of these questions, I will just go to the first slide of it on the market characteristics and technicals, on the next slide, just to show that there are answers there which can tell us if we should go passive or active on each of those questions. Now, I would say that there is no rule again. There are no clear rules, but there are clear questions that one has to answer. And if you really know your market, if you really know your clients, so there are those pillars: your market, your clients. If you really know your house view and the market that you are entering in, you have considered about the service that you are going to deliver through, and you know your products, then you can evaluate and see if you want to go active or passive or both.
Thank you. I think many people are doing both, so it's definitely not an inclusive situation. So unfortunately, we don't really have much time for questions, but we will make sure to publish this presentation, all three of you, and have the video recorded. So if anyone wants to revisit them, you will be able to. And I would like to thank all of you for your time to coming. I would like to thank the attendees for coming, and of course our three amazing presenters to sharing some insights to both passive, active, and kind of the combination of the two. I think it would be very interesting to guess what are the portfolio shifts and how are we going to looking like, and maybe in a year we're going to do another comparison, and let's see what all of you think and where did the market shift it. So thank you again, and see you, everyone, the attendees, in our next RankiaPro conference call next month. And thank you guys for your time.
Thank you.
Thank you very much.